Well, there's been a lot of talk lately about China going dark for a stretch of days and what that quiet window could do to silver prices. So, in this video, we're going to separate what's real from what's hype, and you're going to walk away with a cleaner picture of what to watch and what to ignore. Today is Monday, February 16th. Sounds dramatic, sounds cinematic, but there are two separate questions hiding inside that one storyline. First, is China actually closed, the way people mean it when they say China is dark? Second, even if a big chunk of trading is offline, does that automatically translate into an easy, predictable price smash and then a guaranteed launch higher? Because if you get those two questions wrong, you end up trading a rumor instead of trading reality. So let's start with what we can verify. China's major futures venue has a published holiday schedule that shows a closure through the Spring Festival stretch, with trading resuming on Tuesday, February 24th. So yes, there is a defined window where a major slice of onshore activity pauses. But pause is not the same thing as the world stops. Silver is a global market. When one venue closes, price discovery doesn't disappear. It shifts, it migrates. It keeps moving through other contracts, other time zones, other desks, and a whole lot of over-the-counter flow that never gets the spotlight. And here's a twist most people miss today. US markets are closed for a federal holiday as well. So if you're trying to build a story about thin liquidity, you actually have to account for both sides of the Pacific, because today is the kind of day where fewer traders are at their screens on more than one continent. That matters. And that brings up another detail people don't talk about. On holiday weeks, even the routine reporting cadence can shift, which means people end up reacting to stale screenshots like they're brand new revelations. The weekly positioning data from regulators, for example, has its own release rhythm, and holidays can create gaps that social media fills with speculation. So, when you see somebody confidently narrating what everyone is doing, ask yourself whether they're looking at current positioning or just recycling last week's story with a louder voice. Okay, now the viral version of this China closure story usually includes a villain and a script because that's what gets clicks. But markets don't need villains to move. They just need imbalance. An imbalance can come from something as simple as too many people leaning the same way into a low vol session. Because low participation can amplify moves in either direction. It can magnify fear. It can magnify greed. It can also magnify randomness, which is why the confident step-by-step playbook people love to share. Friday smash, weekend fear, midweek bleed, day 8 fake bottom should not be treated like a calendar you can trade off of. It's not a schedule, it's a theory. And theories break when they meet real order flow. Now, before we go any further, I want to zoom out and make a point that's going to sound boring at first, but it's the whole game. Most of what people call paper manipulation is just positioning plus liquidity plus psychology. Sometimes there's genuine bad behavior in markets. That's true, but very often what looks like a coordinated attack is just the natural outcome of a crowded trade hitting a thin moment, and silver is the poster child for that. It doesn't glide, it lunges, it takes the stairs up, then tries to jump out the window, then remembers it has to pay rent and crawls back inside. So, if you're watching silver during a holiday window, the right question isn't, will they smash it? The right question is, where are the weak points in positioning, and what story will people tell themselves if price hits those levels? Because that's what triggers the chain reactions. Now, let's talk about the paper versus physical argument, because it's the engine behind the biggest claims. You'll hear people say something like, the exchange has registered silver that's ready for delivery, and it's hovering around that psychologically important threshold just under a 100 million ounces in recent updates. Then they'll point to open interest and say, look at all those contracts. That's a few 100 million ounces of promises. And the conclusion they jump to is there's not enough silver. Therefore, the system must break. That conclusion is clean. It's also incomplete because open interest is not a line of people holding cash waiting to buy metal. Open interest is a count of outstanding contracts, which includes hedgers, speculators, spreads, arbitrage, and positions that will be closed, rolled, netted, or offset long before anybody even thinks about delivery. Here's a better way to visualize it. Imagine a busy airport. Open interest is like the number of tickets that exist for flights leaving this month. Registered inventory is like the number of seats available on one specific plane type at one specific terminal under one specific set of rules. If you compare all tickets sold to seats on one plane, you can make the airport look like it's collapsing every day of the week. But the airport doesn't collapse because most passengers switch flights, rebook, connect, cancel, or never intended to board that specific plane in the first place. That's how futures markets work. Delivery is one possible exit. It's not the default exit. And we can get even more specific because the labels people throw around, eligible and registered, actually have formal definitions. In the exchange's own rule language, eligible means metal that meets the contract specs and sits in an approved vault, but there isn't a delivery warrant attached to it yet. Registered is eligible metal that does have that warrant issued, meaning it's ready to be used for delivery against a futures contract. So when someone says registered is low, what they're really saying is the amount of metal currently sitting with warrants is low. That's a meaningful signal, but it's not the same thing as there is no metal, because metal can move between categories when incentives change. Now here's the other nuance that gets lost in the loud version of this debate. When you hear the word delivery, it's easy to picture trucks, pallets, and forklifts. But a lot of exchange delivery is a change of ownership paperwork, warehouse receipts, and warrants moving from one party to another, while the bars themselves stay put unless the new owner chooses to pull them. So you can see high deliveries and still see the vault totals barely budge. And you can see modest deliveries and still see meaningful withdrawals. If you're not distinguishing between those, you're mixing up signals. And that's how you end up emotionally certain and mechanically wrong. Now, does that mean physical doesn't matter? No. Physical matters a lot. It matters because it's the final constraint. You can write infinite contracts, but you can't ship infinite bars. And this is where we need a more nuanced view. The market can be structurally tight without default being around the corner. Both things can be true. And if you want fresh, non-Twitter context for why physical demand keeps showing up, look at how silver is actually used. Government mineral summaries break out where silver goes in the real economy, and the breakdown is surprisingly diversified. A big chunk into electrical and electronics, a meaningful slice into solar, and a lot into investment bars and coins when people are nervous. And to make this even more current, the newest government summary notes that coin and bar demand rose last year, while industrial use held roughly steady because slower growth in one chemical process and lighter silver loading per solar panel was offset by continued growth in automotive, consumer electronics, and power grid uses. That one sentence is basically the silver market in a nutshell. Efficiency improvements are real, but so is the scale-up of everything electrical. And it's not just the US saying this metal matters. Industry surveys have been talking about recurring physical tightness for years, with the market leaning on above-ground inventories to fill the gap when demand outpaces mine supply. Now, I'm not saying that means short squeeze tomorrow. I'm saying it explains why silver keeps finding buyers even after violent drops. Because underneath the trading noise, there's a steady, boring industrial pull. That mix matters because it means silver demand isn't just one story, it's a bundle of stories. When tech cycles cool, solar can heat up. When investment demand cools, industrial can keep a floor. When industrial slows, coin and bar demand can surge during fear. It's not a single lever, it's a dashboard. And this is why silver refuses to behave like a neat, predictable chart pattern. Now let's bring China back into the frame. During the holiday closure, onshore price discovery is quieter. That's true. But the idea that China is asleep and therefore nobody is buying physical is not automatically true. Manufacturers don't stop planning. Supply chains don't stop hedging. Inventories don't stop being counted. And in modern markets, even when one venue is closed, there are still ways to source, swap, and secure exposure through other channels. So, if your entire thesis is China closed equals no demand, you're leaning on a simplification. And simplifications are where traders get hurt. So, what's the real risk during a closure window? It's not magic, it's reflex. If price starts dropping and liquidity is thin, you can get air pockets, you can get stop cascades, you can get headlines that feel louder than they actually are. And yes, there are always commentators who will interpret every red candle as the bull market is dead. But here's the counterpoint people hate to hear. Sometimes the scary drop is not a trap. Sometimes it's a market repricing risk. Sometimes it's just longs taking profits because the move got too stretched and they want to reset. And if you've watched silver the last couple of years, you know it can swing from unstoppable to hopeless in the same month. In fact, even mainstream market coverage recently highlighted how violent silver swings have been and how open interest in momentum can fade after a speculative surge. And notice what that implies. If open interest starts to shrink in a March because big players roll forward or close positions, that can remove a layer of support that people mistake for real demand. In other words, you can have a market that's tight physically, but still sees the price dump because leverage positioning is being reduced. That's not a contradiction. That's the difference between the futures crowd and the physical crowd moving on different timelines. So, if you want to understand whether a squeeze is building, you don't just watch the headline number. You watch whether stress is showing up in spreads, in delivery notices, and in the willingness of holders to part with metal at current prices. That doesn't kill the long-term case, but it does warn you, don't treat a squeeze narrative like a guarantee. Now, here's where things get interesting because while a lot of people are shouting short squeeze, there's a quieter development that actually deserves attention. Silver was added to the latest U.S. critical minerals list alongside other industrial metals that matter for grids, electronics, and national supply chains. And I want to be careful here because people will hear critical and immediately jump to conspiracy. This isn't a movie. A designation like that doesn't automatically mean confiscation or bans or some overnight price reset. What it does mean is the government is formally acknowledging supply chain risk for a metal that shows up everywhere, from circuits to energy infrastructure, and that can shape incentives. It can shape permitting. It can shape how projects get financed. It can shape the political appetite for domestic production. And if you're watching silver is more than a day trade, that's real context. And that connects to something bigger happening across commodities. Copper is the obvious headline metal for electrification, and major research groups are warning about potential supply shortfalls over the next decade or two if new production doesn't ramp fast enough. Why am I bringing copper up in a silver video? Because when grids expand, data centers multiply, and electrification scales, demand pressure doesn't stay neatly inside one metal. Copper moves the power, silver manages the connections. They're not substitutes, they're partners in the same system. So when you see critical minerals language, don't think of it as a single event. Think of it as a sign that the market is becoming policy relevant, and policy relevant markets tend to get jumpy. Now combine that with the basic fact that silver is both money adjacent and industry embedded. Gold can live mostly in vaults and jewelry boxes. Silver gets consumed. It gets built into things. It gets dispersed. It's the metal that shows up in 1,000 small places, which makes it weirdly hard to turn on supply quickly when demand spikes. And yes, there's been a long-running debate about whether solar loadings per panel are declining while overall solar deployment rises. One side says less silver per panel means demand pressure eases. The other side says deployment growth overwhelms thrift. The reality is usually messy. Thrift helps at the margin, But scale wins when deployment grows fast enough. So when you hear someone claim industrial demand is unstoppable, you should think which segment and at what price. And when you hear someone claim demand is collapsing, you should ask which segment and compared to what baseline. Okay, now let's get to the part everybody actually cares about. What do you watch during this closure window without getting sucked into the hype? First, watch the behavior, not the prophecy. If price drops hard on thin liquidity, look for two tells. One, do buyers step in quickly, or does the market stay heavy? Two, does volatility expand while volume dries up, or does volume come in with the move? Those two things tell you whether the market is being pushed around or whether the market is deciding something. Second, watch the premium conversation carefully. People toss around the word premium like it's a single universal number. It isn't. Premiums vary by product, region, and inventory conditions. So when you hear premiums are exploding, your follow-up should be where, on what product, and for how long. If it's a short-lived retail premium on small products, that's interesting, but it's not the same as wholesale tightness. If it's persistent, broad, and tied to large bar availability, that's a different animal. Third, watch what happens when China reopens. Not the first hour, not the first headline. Watch the first few sessions, because if there's genuine pent-up demand, you often see it in the way dips get bought, not in the way pumps spike. Now, here's a cliffhanger I want you to sit with. If the smash story is true, why would anyone powerful want silver to go down right when it's becoming strategically recognized? That's the part that doesn't line up cleanly. Sometimes the simplest answer is it's not a coordinated plan. It's just positioning unwinding, and that's not as fun to say, but it's often closer to reality. Now, I can already hear the pushback. You're downplaying the paper to physical mismatch. No, I'm not. I'm putting it in the right frame, because the mismatch isn't a single ratio. It's a dynamic relationship between inventory categories, delivery intentions, and the willingness of owners to convert metal from eligible to deliverable status when incentives change. Registered is not the entire supply. Eligible exists for a reason. And the moment incentives shift, eligible can become registered because owners respond to economics. That doesn't mean it's infinite. It means it's flexible. So the question becomes, at what price does that flexibility show up? At what spread? Under what stress? And that's why it's smarter to track behavior around delivery periods than to treat open interest like a countdown clock. Now, let's address the other big promise in the viral narrative. March is the reckoning. Delivery months do matter. They matter because they focus attention, they force decisions, they compress time. And if you have a market with tightness underneath, those moments can magnify it. But again, the conclusion, therefore, default is a leap. Most stress events get resolved by price, by spreads, by cash settlement incentives, by moving metal, by reclassifying metal, or by large players rearranging positions. Markets are designed to bend. They don't break easily. And even if you think this time is different, you should build your plan around probabilities, not certainty. So here's a practical question for you to answer in the comments. Do you think the bigger risk over the next couple of weeks is a violent shakeout that scares people out, or a violent squeeze that traps people the other way? I want your honest take. Now, I also want to address something else that was in the competitor narrative. The idea that China has cracked down on paper games, forced delivery, and banned rehypothecation. There's a kernel of truth inside the broader idea that different venues have different rules and different delivery cultures. But the internet loves to take that kernel and build a whole fantasy castle around it. So here's the skeptical alternative. Even if a venue tightens standards, that doesn't automatically mean every contract turns into a delivery demand. And it doesn't automatically mean Western markets are fake, while Eastern markets are real. They're different tools, and different tools attract different kinds of participants. So rather than turning it into a morality play, treat it like market structure. And market structure can change fast, especially when policy shifts. Which brings us back to that critical minerals designation because it tells you something about policy direction in the US. And it rhymes with a broader theme. Supply chains are becoming national strategy. That's not just about silver, it's about copper, it's about grid metals, it's about the inputs that make electrification possible. And when governments start treating inputs like strategy, volatility tends to rise, not fall. Now, let's do one more fact versus fiction check because it's crucial. People love to say if registered inventory is under 100 million ounces and paper promises are a few hundred million, then there are 3 promises for every ounce. Even when that ratio is roughly true on paper, the conclusion, therefore, squeeze next week, still doesn't follow. Because a ratio is a snapshot and markets are flows. Inventory moves, contracts roll, hedgers hedge, spreads move. And the important thing is not the static ratio. It's the direction of travel. Is registered trending lower persistently? Are deliveries increasing? Are spreads doing something unusual? Are lease rates spiking? Are nearby contracts behaving differently than deferred months? That's where stress shows up first, not in a meme ratio. Okay? Now, if you've been watching this space for a while, you know there's always a temptation to turn every story into a once-in-a-lifetime moment. Sometimes that's true. Most of the time, it's not. Most of the time, it's a chapter, not the finale. And that's why I want to keep you grounded, even if the next week gets loud, because the loudest people are usually the least precise, and precision is where you make money. Now, before we wrap the market portion, I want to give you one simple retention tool you can use when prices get emotional. Ask yourself, if I didn't own a position right now, would I be excited to enter here, or would I want to wait for better pricing? That one question removes ego. It turns the screen back into information instead of identity. And if you're successful, share your success story in the comments so others can stay motivated. All right, quick sponsor break, and then we'll come right back to what this week could look like and how to think about it. Today's sponsor is a gold exploration and development company listed in the US that a lot of investors have been watching because it combines 2 things people usually have to buy separately. 1, a portfolio of resource stage projects across the Americas. 2, meaningful equity stakes in other public mining companies, which can create additional upside when the sector gets hot. I'm talking about Gold Mining Inc., trading under the ticker GLDG. Just for transparency, this segment is sponsored, and sponsorships help keep the lights on. Gold Mining Inc. is positioned across the Americas with a portfolio of projects, and it also holds equity stakes in other public miners, which can add optionality when the sector runs. That doesn't make it safe. Exploration is risky, cycles are brutal, and small cap miners can move fast. So, if you're curious, read the public filings, understand dilution and jurisdiction risk, and then decide for yourself. Now, I'm not here to tell you to buy anything, but I will tell you what I look for in these kinds of companies. First, I want to see a clear project focus, not a random gray bag, a short list of core assets that management is actually advancing. Second, I want alignment, meaning insiders have real skin in the game, not just a title. Third, I want transparency. If a company says it has resources, I want that backed by technical reports and public filings you can read yourself. And fourth, I want a structure that can benefit if gold stays strong, but doesn't collapse if the sector takes a breath. What makes GLDG unusual is that it has that mix of its own project pipeline plus those outside equity positions, which can act like a built-in basket of optionality. And yes, you'll see institutional names involved in this space because institutions tend to show up when they think the cycle has turned. So, if you want to learn more, take 5 minutes and look at the company's public disclosures and project summaries. Do your own homework and then decide if it fits your risk tolerance. Now, back to silver. Here's the part people are underestimating. If we do get a sharp dip during this holiday window, the real question is not was it manipulated? The real question is what does the market do after the dip? Because that's the tell. In strong markets, dips get absorbed. In weak markets, dips become trends. And silver can flip between those two personalities faster than almost anything else. So let's map two plausible paths without pretending we can predict the exact candle. Path 1, we get a sell-off on thin liquidity. It feels scary. Headlines get ugly, and then buying comes in quickly, either because physical demand picks up, or because traders see value, or because short-term positioning got too one-sided and snaps back. That kind of move looks like chaos in real time, but in hindsight, it's just a reset. Path 2, we get a sell-off, and instead of snapping back, price stays heavy. Maybe it chops sideways. Maybe it grinds lower. That usually means the market is digesting something bigger, like a growth scare, a stronger dollar, tighter financial conditions, or simply the aftermath of a speculative blow-off. And if that's the path, the squeeze narrative gets delayed, not destroyed. It becomes a later story. Now, here's the cliffhanger. If March really is a focal point, then this week's volatility could be less about breaking the system and more about repositioning ahead of the decision window. That's what big players do. They don't wait for the headline, they adjust before the crowd realizes the calendar matters. So, what should you do with that information? You don't need a dramatic plan. You need a risk plan. If you're trading, define your invalidation. If you're investing, define your time horizon. If you're stacking physical, understand that spot price and retail pricing are connected but not identical, especially in moments of stress. And don't let somebody else's adrenaline become your strategy. And let me say one more thing, because this is where people lose the plot. If the market does drop during a holiday window, it's very tempting to anchor on the lowest print you see and convince yourself that must be the bottom. That's how you get chopped. The better approach is to let the market prove itself. When selling pressure appears, does it get weaker each time? Do rebounds get stronger? Do buyers step in sooner? That's the market showing you the balance of power. And if instead every bounce gets sold and the lows keep getting tagged, that's the market telling you it wants lower prices before it resets. Neither message is personal, it's just information. Now, the big cliffhanger going into the reopen is simple. When China turns the lights back on, do we see immediate appetite or do we see hesitation? Because hesitation would tell you something important, that the speculative crowd might be louder than the physical crowd right now. And if appetite shows up, the question becomes, does it show up in a one-day spike or in persistent bid support that refuses to let the market drift lower? That's the signal that separates a headline pop from a regime shift. Now, I want to ask you one more question for the comments, because it tells me how you think. And finally, subscribe if you want the follow-up when China is back online and the market shows its hand, because the next move isn't going to be announced in advance. It's going to be revealed in the reaction. All right, that's it for today. This is for education and discussion only, based on publicly available information and my own interpretation of market behavior. It's not personalized financial advice, and you should make decisions based on your own research, risk tolerance, and if needed, a qualified professional.